Hi, everyone, and welcome back to another video. I'm Chris Paleologus, joined as usual by Tom Meyer. Today, we're going to be going over a topic that's been garnering a lot of attention lately in the news, and that is market concentration. We'll discuss how we calculate a company's size, what the difference between a market cap weighted index and an equally weighted index, and how those differences and market dynamics can affect your portfolio's risk and return. So Tommy's going to start with what are the largest companies and how do we calculate their size?
So before we jump in further, let's discuss what market cap means. Market cap is the total value of a company's outstanding common stock. Market cap is equal to the market price per share multiplied by the number of shares outstanding. For those of you who didn't know, the S&P 500 is a market cap weighted index. So companies with a higher market cap will receive a higher weighting in the index and have a bigger impact on performance of the index. Proportionally, the performance of companies with a smaller market cap will have less of an impact on the performance of the overall index. And this differs from something like the Dow Jones Index, which is price weighted. So to build off Chris's point, we're going to talk about the top 10 mega cap companies. The top 10 mega cap companies in the S&P 500 now make up more than 30% of the index's market cap compared to 25% during the 1999-2000 tech bubble and an average of 20% over the past 35 years. So the top 10 holdings are Apple, Microsoft, Alphabet, Amazon, NVIDIA, Berkshire Hathaway, Meta, Tesla, United Health, and ExxonMobil. So we're going to put up a chart here just to show that year to date, they've contributed more than 95% of the total return of the S&P 500 as of the end of May.
Yeah, so you can see this is pretty incredible. Almost 100% of the returns being driven by just 10 stocks and an ETF that holds 500 companies. So pretty skewed towards the largest companies. So from a valuation perspective, the S&P 500, which is market cap weighted, as Tommy mentioned, as a whole has a forward price to earnings ratio of about 18.5. The top 10 stocks have an average forward PE ratio of 28 times, while the other 490 have an average PE of about 16 times. And price to earnings ratio is basically just a way to gauge how expensive or cheap a stock is. The higher the number, the more expensive. The lower the number, the less expensive. And this could be a risk because these valuations are extremely dependent on low interest rates, which tend to make the projected value of these companies' future earnings look more or less attractive to investors. So should the Federal Reserve keep policy rates higher for longer, the index may be more rate sensitive and subject to greater volatility than what many investors would assume.
Right. So to illustrate Chris's point, we're going to put up a chart of the Magna total increase since the trough of the great financial crisis. And the Magna is an acronym for Microsoft, Apple, Google, NVIDIA, and Amazon. So off this chart, you'll see that earnings and revenue have grown 8 and 10 times, while R&D and CapEx have grown 12 and 16 times, or the costs of the companies. And with all that, their market caps have grown 20-fold. So with costs increasing more than earnings and revenue, it's not improving fundamentals. The group as a whole looks very expensive relative to the broader market.
Exactly. So most of it's been driven by multiple expansion. So we have another chart here to illustrate. We talked about what a market cap weighted index is. Now we'll compare that to what an equally weighted index is. And basically what that means is that instead of Apple being almost 8% of an index, it'll be equally weighted with even the smallest S&P 500 stock in that ETF. So they'll all have the same weight across all of the companies. And what you'll see in this chart basically is that the market cap weighted S&P 500 ETF is outperforming by more than 10% year to date. And this is as of early June, so June 6th. Which is the largest outperformance on record at this point, going all the way back to 1990. And basically that divergence in performance started with the Silvergate Bank closing down around, I think it was March 8th. And we'll have another chart showing the same information, again, comparing equally weighted index to the market cap weighted index. The first chart's a little bit busy with the lines, but it'll show the market cap being up about 7.77%, while the equally weighted is down 1.2%. And this is over a rolling 64-day return. The bottom chart with the red and the green shows a little bit clearer what we're trying to illustrate. And the green lines when market cap weighted index is outperforming. The red line would be when an equally weighted index is outperforming. And again, you can see that dispersion's almost, it's above 10% as of now. And then finally, this chart from the Wall Street Journal, again, showing the same information, just in a different form, and just illustrating the S&P's performance versus an equally weighted ETF, again, well over 10 percentage points. And that's as of June 5th, which is the going back in this chart back to 1990 is the biggest dispersion so far.
So pretty wild to see. So let's talk about the NASDAQ 100 too. We're going to bring in the NASDAQ. This is also a market cap weighted index, and breadth of the NASDAQ still looks unimpressive. Only 5% of members have made new 52-week highs. And you'll find many of the same top holdings we're talking about in the S&P in the NASDAQ as well. So to illustrate this point, we're going to throw up a chart of the NASDAQ, and you'll notice that the gold or yellow lines at the bottom, we want them to be higher to show the breadth of the market, where more companies are making 52-week highs. But as you can see, they're not as high as they have been in the past. So it clearly just showing breadth is not good at the NASDAQ either.
Right. Only 5% of companies are making new 52-week highs. And ideally, to Tommy's point, we want to see those a lot more stocks participating in the rally. And we can also show the dispersion and performance across market cap sizes as well. So this isn't just a large cap phenomenon. This is also happening across small cap. And when you look at how a large cap index versus a small cap index is comprised, you can see that in this chart, large cap has a much higher weighting to technology or infotech here, about 27.6% versus a small cap index, which has about a 12.5% weighting. And many of those top and largest companies that Tommy mentioned in the beginning are technology companies. So again, that's why you'll see small caps in the portfolio lagging large caps this year.
So the big question you might be asking is, what does this mean for my portfolio? For our clients' portfolios, you will have a well-diversified portfolio with exposure to all types of subsectors, from domestic equities ranging from large to small cap, international holdings, alternative investments to bonds. This is why comparing a well-diversified portfolio directly to the S&P 500 is like an apples to oranges comparison. While all our portfolios will have exposure to those 10 names we went over, whether it be from a fund or individual holding, the goal is to avoid concentration risk like this, which is why diversification is key to try and reduce volatility. So the same subsector does not lead every year, which is going to be shown in this quilt map that we're going to bring up right now.
And this is one of my favorite charts.
Yeah, it just is a good one.
Very clearly illustrates how different asset classes, geographies, market cap sizes perform differently across different time periods. So, in 2010, 2011, 2012, we had REITs leading the way. Later in the decade, and in 2019 and 2020, 2021, there was an entirely different subgroup leading the way. But the main point is going to be found right in the middle of this chart, and that's what's called asset allocation. And there's a black line that connects all of those dots. And what you'll see is that asset allocation is just a broadly diversified portfolio, and it's never the top, but it's also never the bottom. And that relates back to when we do financial plans for people, the success rate of those plans is never based on earning the highest return every single year. And it's certainly not going to be achieved by earning the lowest return every single year. And that's what diversification does. It gives you a smoother ride with less volatility, but still allows you to meet your goals, your long-term goals and objectives. So with that, we appreciate you watching this video. If you have any questions, please feel free to reach out to your portfolio manager. We're happy to answer any questions about this, the topic in this video, or anything else that you may have. top of mind. And as always, thank you for watching, and please don't forget to like and subscribe.
Thanks, everyone.
Thanks.